Anand joins us, represents Axis Bank. Let's take our conversation forward. Rajiv, I'm going to start with a very, very, very basic question for the benefit of home buyers like me. In next 20 to 48 hours, should all of us expect an email which says that your home loan rates have been hiked? Is that as simple as I'm trying to make it sound?
Hi there. In a sense, yes, but you may not necessarily be in the next 24 to 48 hours. What the banks will do is that the repricing cycle is 3 monthly. So you will receive that email somewhere between now and next 3 months. So it is, some of you will get it tomorrow morning, some of you will get it in within 90 days. But the fact that it is going to get repriced now is pretty much certain. You can and I think what is also important is I think what has been well articulated is that this is not the last repo rate hike. And so therefore, please, remember that repo was around 5.15% pre-COVID. So at the very least, we need to get there. And if you look at it in the context of real rates, if inflation broadly averages somewhere in the vicinity between 5/4 and 5/2, we've got to get to, somewhere in that vicinity between 5/4 and 5/2. So that means that anything between 75 to 100 basis points more of repo rate hikes is possible in the next 1 year, which means that it is inevitable that home loan rates will go up further by another 75 to 100 basis points, which means that your EMI will go up during this period. So I strongly urge all of you to ensure that please calculate the amount of EMI that could potentially go up and perhaps start to save so that you have that money to fund it on a month-to-month basis, because as interest rates go up, inevitably EMIs go up. Yes, banks will work with you, perhaps to elongate the loans, etc., to mitigate the EMI impact, etc. But I think for most home loan borrowers, EMIs will go up, not just in the next 90 days, but over the next 1 year. So please do prepare for that.
So, Rajiv, to put things in context again for our viewers, I'm asking you very basic questions. If interest rates they go higher, demand will come down. If demand will come down, it will have an impact on growth per se. Post-COVID, just when the economy had recovered and we are talking about a new capex cycle, a new demand cycle, a new cycle which was coming because of IT professionals who were getting absorbed by the digital industry, the rate hike cycle has started. Historically, the rate hike cycles have started when you have been at the peak of the economic expansion. This time at the beginning of the economic expansion, a rate cycle is started, which is very different. How does that change the demand profile now?
I think one needs to first and foremost understand that what we have seen thus far, or in fact, even what we're seeing today, is a emergency situation in terms of interest rates. Like I mentioned to you, pre-COVID, our repo rate in this country was 5.15%. So anything below that is basically what the central bank and the government of India have done to manage the economy through COVID. So therefore, the first phase is really normalization. And so therefore, moving from 4% to 5.15% is, to my mind, a function of normalization. Point two is that, given the supply chain disruptions, given the COVID situation in China, given geopolitics, given the situation that we're seeing in Ukraine and Russia, we've seen a significant increase in global commodity prices, including food. Ultimately, as we think about higher commodity prices and higher inflation as a monetarist, it is really about too much money chasing goods at this point in time. And so therefore, central banks across the world are beginning to normalize to start with, and perhaps tighten as we go forward, as you contend with inflation. How much of an impact this will have on growth is something that we will have to wait and watch. I did hear your previous speaker talk about the fact that as the interest rate cycles have gone up in the US over the last 50, 60 years, it has inevitably ended in recession. We may not necessarily see that situation. I think you will perhaps see some slowdown in growth, but it is unlikely that we will fall into a recessionary environment.
Interesting. Hi, Rajiv. Aisha here. Good to see you
Hi,
after
Aisha.
a
Good to see you
long
again.
time.
Good to see you.
Okay, Rajiv. So that's the consumer side of the story. Tell me what happens to you as a bank. Do you fear that in this high interest rate scenario, one could see maybe NPAs rise up? You'd reiterated or highlighted a little bit about the visibility on your corporate and retail growth, but I'm sure you have some back of the envelope calculation as to where those numbers are headed next. Then.
So I think if you look at bank balance sheets, I think they're probably in the best that they have been over a decade. Well capitalized, well provided for. PCR ratios, across the banking system are between 75 to 80%. Corporate balance sheets are in excellent, pristine shape as well. Large corporates have deleveraged over the last couple of years. They have raised capital. They have elongated their liabilities either through the local bond markets or accessed global bond markets to elongate liabilities. And so therefore, in that sense, both the balance sheets are in great shape, and the ability of corporate India and banks to withstand any sort of pressure at this point in time is very, very high. As far as corporates are concerned, I think you are going to see different situations in different industries. One of the things that's happened during COVID, based on analysis that we have done, is as we looked at 17 industries, most of these industries have seen consolidation, which means that the top three have actually gained market share. So the big have gotten bigger. And so therefore their cash flows have improved significantly as well. And so therefore, to that extent, there will be some industries where they will be able to pass on the input cost to consumers. In some industries, they will absorb it. And in some industries, you will see margins come off. As an equity investor, you would need to pick a basket where a manufacturer has pricing power. But as a banker, I don't see any issues. Yes, EBITDA margins will probably come down, but it is not as if they're going to get negative. I think they will be more than comfortable for corporate India to be able to service their debt, both interest and principal at this point in time.
Rajiv, I know the point of discussion right now is all about the policy, but I'm very tempted to ask about Citi's retail assets. Tell me, how's the onboarding going with regards to systems, people? What's the initial feeler like on retaining customers?
Aisha, you know that the transaction has been announced, and the integration process is going as per plan. Obviously, there are regulatory approvals that need to kick in. So all I can say at this point in time is that the integration process is progressing well.
Okay, so the integration with the Citibank deal going on well at Axis Bank. Good morning. This is Nantara also joining in the conversation.
Hi,
Nantara. I think your first answer, you said you would urge consumers to make sure they have enough money in the bank because EMIs will go up. So you discussed that. What about deposits? How do you see deposits going forward, particularly for your bank? One bank has already said there will be no changes.
I think if you looked at the non-retail deposits, which is basically market-driven, the bank CDs, if you look at deposits that banks get from large corporates, etc., those have already repriced. Two is we have already seen the short end of the curve increase, one because of the fact that in the previous policy, the erstwhile 3.35% was was made redundant. Short-end rates moved to 3.75%. That number will now move to 4.4%. So it is inevitable that that deposit rates will go up. But as Nico's mentioned, that will go up with a lag. Having said that, some banks, including us, some part of our savings accounts are repo linked. That will reprice immediately. So depositors should see, a certain set of depositors should see slightly higher levels of interest really from tomorrow itself.
Okay, from tomorrow itself, if you bank with Axis Bank, deposit rates will be going up. Thank you so much for joining us live today on this edition of The Market, a day after the RBI surprised everybody by announcing the rate hike at 2 p.m.